You guys raised a lot of money. Why do you need so much money?
We're kind of going for it all here. Like, we're not just going for yields.
Okay.
Right now, businesses can sign up with us and earn up to 4% potential yields. We have a conservative yield offering. We always have. But phase two of the company is why we raise the money. That's not the end all be all. We're going for the entire corporate finance stack, and we think it can fundamentally be done better when built on crypto rails, but without making that clear to the end user.
Okay. What is corporate finance for those that don't know? Like, explain, is that just like counting, hey, how much revenue we have and what our expenses are, or what does that entail?
Sure, yeah. Specifically things like invoicing, things like treasury management, things like spend ultimately. Forex is a big one. But these are like the practical use cases of crypto, not the cosmic brain things. Like, anyone could pitch anything in 2021 and get funding.
Correct.
We come from the ground floor of an exchange, so we know what actually like people need, and that's kind of what we're going for, and that's what the money's going to be used for.
So people so far, until recently, they come to Meow, which I'm saying it correctly, right? And they look for treasury management, like yield generation, meaning that rather than have cash sit in the bank at whatever bank and earn 0.03%, I think is the average in a deposit account, they can come to you and earn up to 4%. Yeah. Where does that yield come from?
Yeah, so that's a great question. So how we've done things differently from day one, and this is back when we started in April of last year, 2021. We made it so that the customers actually had to pick exactly where their funds went. So it's not like a black box. You give the money and it says, all right, we'll give you an interest rate. They have to pick. Do they want it to go to an institutional lending desk like Genesis? Do they want it to go to this desk? Do they want it to go to a DeFi protocol? Their money goes exactly where they want it to. And we also only face accredited investors. So we don't face retail. So those are the two differences for us. But it is mostly institutional lending desks that traditionally lend to crypto hedge funds, et cetera.
So when I run a business, let's say I'm the CFO at some large corporation, I'm staring at tens of millions of dollars sitting on our balance sheet. I'm like, damn, we're getting crushed with inflation. I want to earn a little bit more yield. I come to the platform and I'm able to pick who the counterparty is in the sense of the actual lending desk, and there's a yield that is associated with that. What kind of diligence can I do, or like how do I decide? Right, if there's 10 different options or 5 different options, like how do I, as just a regular CFO that doesn't know that much about crypto, know who to go with?
Yeah, so it's kind of painful for us, but we have to write like 30 pages of like the risk profile of everything and explaining exactly what could go wrong with everything. And we get on calls with all of our customers and we make sure they understand the risks fully. We send them documents, we send agreements, and when they are accredited and when they understand the risk profile of these offerings, they pick what makes sense for them. Some corporates like to do pretty aggressive high yield stuff, ranging in like 6-7%. Now, we never dabbled in the 20% stuff that a lot of the retail apps did. That just didn't add up to us. Like, that was sketchy from day one to us. But we definitely curate to some extent, but it's ultimately up to the investor. Yeah.
So 4% sounds a lot closer to what you'd see in the traditional world than there was people running around offering 10, 11, 12, 13 crazy numbers. Why did those high numbers sound so risky? And what is your analysis as to what people were doing there that you guys don't do?
Yeah, it's a great question. So unfortunately, retail only competes on one vector. So retail yield apps, for example, it's the rate. And retail investors tend to be uninformed, and that's why they go after the highest rate possible. And so one retail app would be offering 10%, and then the next one would try to one-up them and say, we offer 12. And that would keep going and going and going. And the only way to do that in the crypto world was through the Anchor protocol. That was UST. So pretty much all these retail apps, or the vast majority of them, were taking people's cash, converting it to UST, putting it into the Anchor protocol, which, as you know, UST blew up, and giving a dollar liability to their end users. So even though the interest in the Anchor protocol went back to the asset that was UST, the yield app was saying, we're going to pay you in dollars. So that was where the mismatch came. And when UST lost its peg and it went to zero, that's why they lost a lot of money. So those were the incentives for retail. Corporates is a totally different story. They care about being conservative. They care about risk reward. They care about understanding the risk profiles. But that's why retail apps got in a lot of trouble this time around. Now, not all of them, but most of them.
Most of them.
Yeah.